I would just like to give some outlook or some background info on the Free Market Roadshow and why we, as the Austrian Economic Center, had started this. And this was like in 2007, 2008, actually before the first financial crisis had hit Europe. We were thinking that we should export the good old Austrian school and the ideas of the Austrian school, which is nothing more than markets, competition, and actually also responsibility, individual and entrepreneurial responsibility. And hand in hand with that, we had a government back then, which was center-right, which did all the structural reforms that were highly needed. So we thought, why don't we combine the Austrian School of Economics, founded by Karen Wendt, which is 150 years ago now, and with his book on the principles of economics, where he actually wrote a lot about money, about sound money, how to issue money, who is supposed to issue money, whether it should be done by government or not. All those kinds of topics were discussed 150 years ago by him. So, and then we thought of exporting the good ideas, that the good structural reforms that we had done. Of course, talking with a Swiss audience, you don't have to do that. There is definitely no need to discuss that on that level, but we then immediately learned, when the financial crisis had hit Europe, that we cannot export good ideas, but we have to find pro-market solutions to solve those issues and avoid those shocks that had hit Europe. And just to give an example, we also discussed the migration crisis, or the migration issue, in 2012 already, and then it hit Europe in 2015. So, as you know, or as you can imagine, the roadshow is always a little bit ahead of time, and I'm glad that you took this initiative and that you are ahead of many other individuals and great people who are discussing those things. And usually with the Free Market Roadshow, we do live events. We travel 40 countries in Europe, and with more than 400 speakers, tour within 8 weeks through Europe, through the country, and discuss those issues, the pressing issues of our times. And as you mentioned, Karen, or as you suggested, this is definitely one of the most pressing issue, how we will deal with not only the PEP programs, but also what the European Commission has suggested, but also what is coming from Switzerland. And Switzerland is much more advanced with regards to CO2 emissions and emission trading and pricing and carbon pricing. You are much more advanced than we are in Austria and other European countries. But the issue is how to finance sustainability and how to deal with sustainable finance per se is definitely something that we need to discuss further on. And without further ado, I simply would like to hand over to Karen, who will act and be our first keynote speaker, and whom everybody of you in the audience knows and has already seen and met at previous roadshows. And Karen Wendt, the floor is yours. Thank you so much for pulling this together and for running the show. And I have to apologize if I turn off a little bit earlier, because I need to run to another event. Britta has already told everybody to excuse me, but I will be there and at least listen to the keynote, to the first keynotes, and then start listening to the debate. Yeah. Thank you again.
And Barbara, you are known for asking very tough and good questions. So I hope we will have you in this role as well.
Okay. You can count on that.
I can count on that. Okay, that's very good. So first of all, thank you everybody for joining today. So we're talking, definitely believe it or not, we're talking about sustainable finance, because sustainable finance is not just CO2 emissions and green finance. It's also about systemic stability, and it's also about what are the functions of money in the future. And therefore, we see a lot of disruption happening, and sustainability has to deal with this disruptive questions. And this is why we also include a lot of stuff and a lot of perspectives on blockchain, on DeFi, so decentralized finance, and on crypto funds and tokenization of the economy. And this leads me to the topic of the day. We are talking about disruption, political disruption, social disruption, financial disruption. And we really want to be ahead of time, so before the mainstream, and want to understand what does decentralized finance brings to the table to the financial industry in form of risks and opportunities. And there we see, of course, the systemic risks, we see the market risks, see credit risks, maybe technical risks. We'll talk about that. And we also want to understand what are the opportunities. So why do we need decentralized finance today in our society? And is it rather a threat, or is it rather than an opportunity? And this I will discuss today with our panelists and our keynote. Our keynote is Matthias Nadler from University of Basel. He is researching together with Fabian Scher about all blockchain-based topics, digital currencies, and decentralized finance. Then we have a panel, and I hope we will have a good discussion about not just the risks, because Matthias will, in his keynote, focus mainly on the risks that DeFi entails. And thereafter, we also want to talk with our panelists about the opportunities. And there we have Katrin Schuler as well from the University of Basel, Bernhard Leutzinger, the CEO of Crypto Finance. Okay, then Diana Netjeva and Leon Créon from BVV, Blockchain Venture, and Georges Boyard from the Farmers Fund. So we have participants who are in the financial industry, who are dealing day by day with DeFi and blockchain and crypto assets, of course. And and we are seeing the first funds in decentralized finance, and we want to understand what are the opportunities and how do we deal with risks. And therefore, thank you very much for being here for a very avant-garde topic. The financial industry is known for combining always volatility and creativity. And now, this volatility and creativity has to be based on a new underlying, which is a technical underlying. And I'm very interested in hearing from Matthias Nadler what the risks, and especially the systemic risks, you see in decentralized finance and what this animal is about. Matthias, the floor is yours.
Thank you, Karen. Let me share my screen for the presentation. All right, can you see it? All good?
Definitely, yes. Mm-hmm.
Okay, thanks for the introduction. As you said, I am from the University of Basel. I'm here together with Katrin Schuler, and we are specifically from the Center for Innovative Finance. And I will give you a quick primer on decentralized finance, what it is, what is different to more traditional finance, where the chances, opportunities, I will not go into too much details, but we'll mention it. And then we'll go into different categories of risks that this new technology brings. So depending on who you ask what DeFi is, you will definitely get a different answer. There's no widely accepted clear definition of the term. We would like to offer our definition, which reads as DeFi or decentralized finance employs public blockchain networks and smart contracts to build an open, transparent, composable, and non-custodial financial protocols. So let's unpack this. Unfortunately, we don't have time to do a primer on blockchain as well. But I imagine everyone listening has at least some idea of what blockchains are, and smart contracts are essentially protocols or pieces of code deployed and built on blockchain networks. And with open, we mean by default, decentralized finance has no access restrictions. So the blockchain doesn't know where you're from, doesn't know how you look, and at least it doesn't care how rich you are. It is, at least in theory, fully transparent. Every interaction with the blockchain is permanently and immutably recorded. So given enough time or effort to reconstruct the history of the transactions, everything is fully verifiable by anyone. Composable, an analogy you will hear often is that these different financial products and protocols are like Lego pieces. And we can freely combine these Lego pieces, build on top of them, etc., to really tailor an investment experience or a new protocol by using anything that is there. So the openness is not only for other users, but also for other protocols. Non-custodial really means there is an absolutely minimal trust requirement when interacting with decentralized finance. There is basically no institutions or middlemen that you need to trust. Everything is settled atomically, as we will see. To visualize the technological side of DeFi, it helps to think of it as a layered model. So on at the base, we have the settlement layer. This is basically the infrastructure, the blockchain. I will always use Ethereum as an example, but this translates basically to any smart contract blockchain platform. On top of the settlement layer, we have the asset layer. Give you a few examples of asset on the next slide. And with these assets, we can then build or replicate financial instruments that we are used to from the traditional financial market, like exchanges, lending platforms, etc. And the technology also allows us to innovate and maybe build protocols that were not possible before. The application aggregation layer is mostly the user-facing front end for the applications. A few examples of assets. Generally, we differentiate between two asset classes in decentralized finance, and those are the fungible assets. These are your stable coins, your governance tokens, etc. And then we have non-fungible assets. These are usually more complex assets. They can be, for example, your whole liquidity position, including different properties, can be tokenized as a single asset. But also tokenization of off-chain or of real-world products is possible. You can have a famous painting tokenized, and then this will be represented as a non-fungible asset. And of course, the native protocol asset, which in the case of the Ethereum platform is Ether. So what are the differences to traditional finance? I alluded to this, but we are in DeFi, we're moving from a trust-based execution where you have an institution or someone that does the transaction for you to a completely deterministic execution. So that would mean I can, even before I make a transaction, I can test this transaction on my local machine. I can see, okay, what happens if I do this transaction, and if I'm happy with it, assuming that nothing changed in between, I can be absolutely sure that this transaction will be executed exactly like this on the blockchain. We don't need any centralized clearing or settlement parties for the vast majorities of transactions that we do on the blockchain. And it works with something called atomic settlement. So we can construct a transaction, set some parameters, some requirements. For example, I want to send you token A, and you have to send me token B. And atomic settlement means that if any part of the transaction fails, for example, if you don't have enough token A to send me, then the whole transaction will fail and revert, and it is as if nothing happened. And by constructing transaction in this atomic way and requiring all the parts of a transaction to fully complete before a transaction is valid, that means we don't need anyone to hold assets in between or really any form of third-party arbitrator. Another difference is that we have full composability. We can really build our own investment experience on the blockchain. We are not subject to the services that institutions offer us, which are often very isolated and non-composable services. Let's do a few more. Institutions are often geographically maybe not limited, but they're usually not active everywhere, and even worse, there are parts of the world that have no financial inclusion at all. So where no banks or other financial services are offered. And decentralized finance is a truly global market. All you need to participate is the internet and maybe a web browser or something similar, and you can participate from everywhere. This is not only important for the financial inclusion, but it is also important for capital efficiency. So if the return on capital is higher in certain parts of the world, we can really move our capital across the globe in a matter of moments and ensure maximum capital efficiency. And a final difference, I really like this analogy that a traditional banking or financial transaction is like writing a letter. So it takes about a day to arrive, maybe more sometimes, and it goes through the hands of a couple people usually. And a decentralized finance transaction or a blockchain transaction is settled almost immediately. Depends a bit on the exact protocol that you're using, but it is much more comparable to email than to normal letters. And I believe that that decentralized finance has the same chance to revolutionize the finance sector than that email had for the communication sector. So yeah, this analogy helps to really understand the magnitude.
So this is what we very often hear, from the community, that it's like the internet revolution.
Yes, all these aspects together really open a lot of new possibilities that we didn't have before. Mm-hmm. Before we get too excited, of course, we have to talk about the risk that this new technology brings. To be fair, some of the risks that are exclusive to the traditional financial systems, which disappear with DeFi, but with new technology, we have new risks that we need to be aware of. And I'm going to split it into the more general risks, which are usually protocol specific, and systemic risks, which affect the whole market, the whole ecosystem. So when we talk about openness and especially non-custodialness of decentralized finance, that means you are truly in control of your assets. But being in control of your asset also means you're vulnerable to attacks that try to take these assets directly from you. You no longer have an institution with advanced infrastructure protecting your assets. So phishing attacks and similar attacks are a concern. And also the immutability of blockchain means if you mess up, if you do one wrong transaction, there's not really a way to undo it or to go back So that is definitely a risk. And a big risk that is often talked about is smart contract risk in general. Smart contracts are essentially just program code that is deployed on a blockchain. And as all programs, these are subject to vulnerabilities or bugs in the code. And just a few weeks ago, we saw an example where a single wrong character in a smart contract cost more than $100 million of losses for a protocol. So it's a very real risk. It's often talked about. And in a similar way, we have economic attack vectors where the protocol works as it is intended to work, but maybe we made some wrong assumptions. We take pricing data from a compromised source that can be manipulated and lead to losses for the protocol. Governance attacks are a bit more complicated, and to fully explain it, I would need to explain how these protocols are usually governed in decentralized finance. But a very simple version is that the equity of these protocols is often freely available and tradable on these markets. So someone can buy or even borrow voting rights for these protocols, and in a very, very short amount of time can amass a significant influence over a protocol. And this can be a bad actor, but it can also be a different protocol attempting maybe hostile takeover of another protocol. A last risk I'm going to mention is centralization creep. Not everything that is labeled as decentralized really is decentralized. And oftentimes we find hidden admin keys in protocols, or like functions to pause a protocol, or even to blacklist certain addresses and prevent trading. So you always have to be on the lookout if a protocol has these centralized fallbacks. Now, let's move to systemic risks. And to better be able to explain systemic risks, we have to look a bit more directly in what is happening in these decentralized financial protocols. So a big concern, and this was the topic of our first research paper in the Center for Innovative Finance, concerns the transparency, and we call it the wrapping complexity of these tokens. And again, as a reminder, tokens are assets on the blockchain, any kind of asset. And usually when you interact with a protocol, you deposit your assets on this protocol. And in turn, you will get something like a voucher that is a claim on your asset. And at any time, you can redeem your voucher to get your asset back, including all the interest or all the rewards that you accrued. But kind of the funny thing is that these receipts, these vouchers, they are tokens themselves. So there might be another protocol where you can take your voucher and go to the next protocol and deposit your voucher, and then get a voucher for your voucher, etc. And it can really introduce these very, very high, we call them wrapping complexities, where it is very intransparent who actually owns the tokens, and the interconnectedness of these protocols in these wrapping steps, they really amplify the risk that if something goes wrong, it will spread to all the other protocols. So this term wrapping complexity is something we introduced to measure the integratedness of a token, or also the potential risk that a token has in an ecosystem. The ultimate conclusion of our first paper, I'll read it for you, is there's a particular risk that high ownership concentration and complex wrapping structures introduce governance risks, undermine transparency, and create extreme interdependence affecting protocol robustness. So especially the last part, this is also the direction we decided to continue with our research, to really try and see how this high interdependence affects the robustness of the whole ecosystem. And the literature we looked at is the shock propagation literature from classical financial network models. And before we can go there, we need to introduce a couple more concepts. And the first is that anything on the blockchain really is pseudo-anonymous. That means rational actors in the system, they cannot be held accountable. There's no legal recourse. That means the protocols, they really need to make sure that, for example, the borrowers don't get an opportunity to take their money and run. So everything in DeFi is over-collateralized. And that is very important to understand. And it gives a really solid foundation to start on. As long as everything is over-collateralized and liquidation of position works, then we have a really stable system and a really good foundation to build on. But there are a few issues why, even though we have full over-collateralization, liquidations might not always be as smooth sailing as we want to. And at the core of this problem are the oracle risks. And as an oracle, we describe a protocol or an application that moves information that is not available on the blockchain onto the blockchain. So, for example, if the Ethereum blockchain doesn't know what the Ethereum to US dollar price traded at, for example, Coinbase is. This information has to be published on the blockchain. And this introduces really a lot of risks, a lot of key points where it can go wrong. And this is one of the largest points of failure that we identified. I'm not going to go into the details of how it can go wrong, but if it goes wrong, if oracles fail, or if we have other protocols failure, for example, if a protocol is attacked and liquidity is strained, this will lead to losses for the protocol. And if these losses can't be absorbed by the protocol or the equity, then we will see something akin to shock propagation in traditional finance. And it actually works very similar to what we observe in traditional finance. This is one of the findings in our most recent research. And additionally, something to keep in mind is that disconnectedness and composability is really at the core of DeFi. It is essential, and it is what DeFi is built on. And these are really catalysts for shock propagation.
So it's the external information which you take on the blockchain, so the information which is not created by the blockchain, but which is taken from other systems. And yes, the blockchain does not know that. And this creates the oracle risks.
Yes. So usually, or the most important data is pricing data. Anything that is priced in traditional finance and needs to be available for a product in decentralized finance needs to be transferred to decentralized finance. And there's very robust protocols to do this, but it is still, in our opinion, one of the largest potential points of failure. And we have seen it fail in the past, not spectacularly, but there are definitely issues that need to be further researched. And this brings me to the end. The key takeaways for this quick primer is DeFi is super exciting and it is most likely here to stay. However, it requires a lot of due diligence and research from the investor side to make it a relatively safe experience at this point. And either by doing the research yourself or by finding someone to do it for you. And we definitely need more researchers and also institutions in this field that come together to better understand these risks. And as a last key takeaway, there definitely is a place for finance in decentralized finance to absorb these risks for the customers, to do this risk research and provide a bridge for the user into DeFi.
Thank you very much, Matthias. So I hope we have all lots of questions. So first of all, let me start with one. Yeah, there is a saying in the financial industry: you should only buy what you understand. And here we have to understand a lot of new things. First of all, we have a new technology behind creating a financial asset. We have an underlying, which is a protocol, and it is a self-executing contract. This is, I think, which you presented very nicely. So what happens if something, so there is one oracle risk, the information coming from outside, which might be wrong, which is posing a risk, but it could also be that there is something wrong in the protocol, or one situation you didn't think about in the protocol. So finally, as an investor, you first have to understand the protocol itself, and you have to understand what happens if a situation occurs which has not been thought of when the protocol was created, because it means it's self-executing. There is no human intervention. What happens then? So the loss is then the transaction incomplete? Is it just sent back? Is the loss absorbed by the protocol because there is an over-collateralization, or how does that happen?
So if the transaction is in some way not valid, if you're trying to do something that is not possible, then obviously everything will be reverted. You will pay for the transaction still, but nothing will happen. But if you are doing something that is within the limits, or within the boundaries of the protocol, and if maybe the protocol forgot to consider this, or maybe you devise some clever arbitrage opportunity that no one saw coming, then you will be able to execute this. You will take the profit from it, and the protocol will absorb the full losses. And
as long as it can, through its over-collateralization.
Everything is over-collateralized, and usually it means the users of the protocol have to absorb the losses. Or it depends on how the protocol is set up. In some cases, the losses are absorbed through direct reserves of the protocol, or maybe just through the equity of the protocol. So all the governance token for the respective protocol will absorb the loss.
Wow. Okay, so that might be if I am one of the protocol owners, or if I have invested into the protocol, then I will absorb the losses. So I have to make sure in my due diligence, absolutely, that the protocol has thought about everything, every potential situation, and that I really understand the protocol and have been part of the stakeholder dialogue that normally happens in creating the protocol. Is that correct?
Yes, you can take this.
Yes, to some extent. I think what Matthias also maybe has indicated with it might be no protocol functions the same. So there are protocols where, as said, there is this absorption of losses through minting of new protocol tokens, which you could set equal to being absorbed by equity, because just market capitalization, more protocol tokens go on the market, so the value of each token diminishes. But there are also other protocols who proactively offer their token holders that they can stake their protocol tokens as part to absorb such losses, and then they earn extra yield on that. So it's really difficult to make a generalized statement about that. But it is, as you said, the same for users of protocol as for investors of protocol. They need to take a very diligent look at what they are investing in or what they're interacting with, and it takes a very cross-disciplinary skills and knowledge, because we have technical aspects, we have economic aspects, we have behavioral aspects.
Mm-hmm. Okay, that sounds really fascinating, and I take away that the financial industry is creative enough to create a good over-collateralization where you can stake for just absorbing these risks, and so this means as long as the risks do not materialize, you get your premium, your risk premium, your risk reward, and when it happens, then the risk will hit you. Let me see. So who else can has a question to that? Let me see. Look into the chat.
I think there's a question in chat concerning the Chainlink Oracle service.
Yeah.
Yeah. So yes, Chainlink does a lot of the things in a very good way. It's a decentralized Oracle. I mean, it eliminates the attack vector that a single party can influence the information. However, a few of the problems remain, even if we use the most decentralized and the fastest Oracle. One of the key problems, I would say, is that blockchain happens in discrete time. So you have these blocks, and between the blocks, nothing changes. And you can only have updates every X seconds or minutes or whatever. And if too much happens between two updates, we can be in a situation where in one block, your position is totally healthy, and in the next block, it is completely underwater. And this can be amplified by for example, the congestion of the network. If prices are moving a lot, then we have a lot of activity on the network, which means it will be harder or more difficult, more expensive to publish these Oracle updates. And yes, and also the liquidation process. So it's not just enough that the prices are updated. Also, the liquidations of these positions need to happen fast enough. And if they don't, then suddenly we have a debt that is worth more than the collateral, and we have losses for the users.
Okay, I think we have now discussed a lot of the risks. Let me bring in now the panelists, because we have people here really creating funds that invest into these protocols. And so I'm also eager to hear the upside. So we will now include Leon Grion from BVV together with Diana Netjeva and George Boyar from Farmers Fund, Bernadette Leutzinger, the CEO of Crypto Finance, and last but not least, whom did I forget? Yeah, of course, the University of Basel, Katrin Schuler and Matthias. Let's go to the discussion. So just talking maybe first to Bernadette, because you're so long in the market and you have you're a self-learner. This is what you said about yourself. So you have been digging into blockchain, into crypto assets. Your institution is growing, and currently in so there is an acquisition proposal from Deutsche Börse. So we seem to move into a market where crypto gets more commonplace and more mainstream. So what do you think about DeFi? Is your institution also investing in DeFi? Are you creating funds? What are you doing there?
So on the DeFi side, personally, obviously, I'm super interested. That I want to say first. From our company perspective, DeFi is obviously something we are looking at and we're considering. However, right now we are really on the fringes only, especially when it comes to our investors. There, as Matthias said before, there's still a lot of risks there. And investors, I think, also have to get on the journey to understand these risks. We started with the company back in 2017. when a lot of, especially institutional and professional investors, were not even talking about Bitcoin or Ethereum. Now we're at a point where everyone understands these topics, or is at least educated and talking about them. But I think DeFi is a next step, which is still, in my opinion, in kind of also an experimental phase, where everyone has to get accustomed themselves before you actually have, let's say, the big funds and the big institutions investing in it. Obviously, what we already see is more, let's say, on the venture side, where we have a lot of venture capital that goes into the developer teams that are behind these projects. And that's obviously an interesting approach, but it's more the venture approach than actually investing in the protocol and the tokens themselves. So there I see how the landscape is developing. And like 2-3 years ago, nobody was talking about DeFi. There we were talking about the base layer protocols. So I think it's a development, and there's still a lot of research to be done. I'm glad that we have the University of Basel here that actually does research in this area, because I think that should be way more common nowadays. So I think we're on an interesting journey to see where we can go with this topic, and it's for sure not going to go away.
Okay, so that is the main benefit for the venture capitalists, that they have, or that they create programmable money, and is the risk on the institutional side due to the fiduciary duty? So is it more a product for let's say high net worth individuals, family offices, so all the professional investors who do not have fiduciary duties at the current point in time?
Yes, I think for them it's especially interesting to play around with a small part of their portfolio, which is more like playing around, being in it themselves, seeing how it works. When it comes to decentralized finance. Obviously, when we're talking more about the base layers, the established protocols, if we're talking about Bitcoin, where, for example, there is no Oracle problem per se when you transact on the blockchain, right? So there, I think it's really decentralized finance is the next step. Then obviously what we also see is, and then by the definition of Matthias, it's debatable if that's then still decentralized finance, but obviously financial institutions that build their financial products on a blockchain, may that be a public blockchain or a private then, that obviously also reduces some risk and can be quite interesting because everything is more automated. It's more digital, you don't have the settlement issues anymore, but there is a financial institution that is in the back. So obviously there, from the risk perspective, they can absorb some of the risks. They will charge something for that for sure. But there's so many ways and so many directions we're going with this overarching topic. So I think that's quite interesting to see, and also where we see huge interest at the moment, definitely.
So can they just absorb the risk, or can they adjust the protocol?
It's more that obviously if you're talking about financial institutions issuing something on the blockchain, that mostly you have some admin keys that the financial institution has, that they maybe, depends on how they construct it, but that they have some fallback options, that they can reimburse investor, or like the simplest idea would be that you only have whitelisted participants in that protocol, so it's no longer the pseudonymity per se, but you have a whitelisting process, so you know with whom you're interacting, and that obviously reduces that risk factor that Matthias talked about as well. Also the overcollateralization part, which then becomes a different topic. So I think it's really so many things you can do, from the super decentralized original crypto part to the more financial institution part. That it's really a scale where so much is possible, so much innovation is possible, and it's so interesting to see what's all going on there.
Wow. Yeah. So now we have two participants here who, think at least about creating a fund, a DeFi fund. And maybe let's start with George Bouillard, because I think your fund is already up and running. So why do you do this fund? I mean, it appears there's a lot of risks, and why should anybody invest into DeFi?
I mean,
or
like
are
the
you
very
the one
simple answer.
who is understanding this, and we all have to trust you finally, that you are able to read the protocols and to make no mistake?
Well, I think Matthias captured this very well. Like, these things are still speculative and still very risky. But if you understand what you're doing and you have good pattern recognition, and the truth is, the more that you get involved, the better decisions you'll make. The risk is not effectively priced in. There's an amazing amount of opportunity to have good returns. Like,
so
some
good
people
returns
will be
means 100%, 400%, 500%. So what is a good return?
In my field, it's more on the latter side. Like, multiple hundreds of percent would be considered a good return in yield farming. But it also really depends on the level of risk you're willing to accept. And there's like different categories of risk too, because to have the highest returns, you have to be in more speculative assets that aren't as well established. So, for example, if you really want to denominate your portfolio in something that's been around a very long time, like Bitcoin or Ethereum, it's going to be quite hard to have multiple hundreds of percent return. But like 50 or 60% is totally achievable with not a ton of effort. And that is not going to be sustainable in the long term. Like, compounding returns just does not allow you to have an asset class that returns 50 or 60% per year. It's just not possible. But in the short term, when we're still in this very early stage of this asset class and there's a lot of new capital moving into it, there are a lot of opportunities to have these kinds of returns.
So the premise is that we can multiply the capital?
Yeah, so broadly, the way I categorize crypto right now, so like there's like kind of layers of thesis. The first thesis is like, this is maybe an uncorrelated asset that I would like to have in my portfolio. If you've like kind of come to that conclusion, you can begin asking yourself, how do I want to play this asset class? And in general, I see like 4 buckets of ways to do it. The first was already alluded to, where we're seeing more institutional capital move into more of the traditional private market venture model, where they are making private investments and having equity stakes in business that are building infrastructure in the space. The second approach is more of your traditional buy and hold strategy, or maybe you hold something in spot on a centralized exchange, or you can also do this in a self-custodied way directly on the blockchain, but you're not really doing too much beyond custodying the assets. The sort of third approach is more of a like high frequency trading strategy, where maybe you don't really think about the value of the asset, but you are attracted to the volatility of the asset class. And then the fourth is kind of a hybrid version of the buy and hold strategy, which is referred to as yield farming. And that's like specifically what I specialize in.
Okay, so very interesting. So you are positing, you could also use that as an uncorrelated beta, creating uncorrelated beta if you are, let's say, a conservative investor. And you want not to be hit if the market by the market volatility. So it could reduce. This is what you say. The volatility, or long term, it not necessarily moves with the share prices.
I think this is definitely the thesis behind a lot of investments into crypto, but it hasn't fully played out. Like, we have not seen a like unbundling of crypto from traditional asset performance. That said, there are a lot of fundamentals about this asset that give me an incredible amount of confidence that we will see that. I don't know if that's going to be in like 1 year, 5 year, 10 year, but it's like a really asymmetric bet that you will see this kind of unbundling in the long term.
Okay, so while volatility, strategies seem to be very near to strategies that you have in the traditional market, what is yield farming exactly? What are you doing there?
Yeah, depending on who you talk to, you're going to get different answers. I think of it as being broken into 2 like fundamental activities. The first is engaging in money markets. So this would be the equivalent of loaning out your crypto assets for interest. And then the other is kind of participating in these automated market making protocols, where you're providing 2 sides of a trading pair and keeping some of the spread or fees that are charged when people transact between these assets. The reality is that the sort of interest from loaning out your capital and the trading fees are not a very large amount of the returns. It's single-digit percentage. The sort of very high returns come from these sort of incentives that you're paid for engaging in these protocols. And that is generally denominated in the token of the protocol you're working with.
So you're co-creating. So Jared, sorry for interrupting you. Mm-hmm. So you're co-creating the protocols, right? And there's an incentive for being part of the stakeholder dialogue, for giving input, and
you certainly have that opportunity. A lot of protocols will operate on a sort of system called like governance voting or token voting. You don't necessarily have to engage in that. The way that I would mental model it is a little bit more of like customer acquisition costs. So these protocols are businesses, and they are selling their equity to get users into their protocol. And then you as an investor are speculating on whether you think that this protocol is a valuable business and you might want to hold it, or if you would prefer to sell it on the open market and purchase something else. So the mental model that I would encourage people to use is, I'm based in the US, but this would be a little bit like if every time you made a trade on Fidelity, they gave you a little bit of stock. And that's kind of what's happening in crypto right now.
Okay, thank you very much. Leon Grion and Diana Nedjela, you are as well working on decentralized finance fund. So what is your rationale? Why are you interested in going into that market? So, I mean, Blockchain Ventures has already achieved a lot, and DeFi is a new topic. So why DeFi and why a fund?
So I might jump in first, and then I'll gladly hand over to Diana, who I'm sure will add some more context. But look, I think what we're looking at here, for the reasons already outlined, is a fundamental paradigm shift of what venture investing looks at is power laws, right? So if you look at portfolio constructs and how venture funds are returning their capital to investors with hefty returns, it's typically one or two companies that is able to achieve a certain scale mass. Coinbase was an example of a great company that made a lot of people a lot of money from the early seed stage investors. And that's how the industry works. Now, within DeFi, we're able to apply an order of magnitude on top of the power law principles when it comes to venture investing in this space. And the reason, as we see, I mean, protocols and groups like Aave and Uniswap, I mean, their token price appreciation that's possible is eye-watering. And in a moment, Karen, you asked about some numbers, so I'll share my screen in a second and just contextualize that. But factually speaking, it is very early stage in this industry, in this space. The opportunities are clearly there for the reasons which Matthias and everyone else has touched on. And then the way in which people participate in that is certainly something that needs to be well thought through. And factually speaking, a balanced portfolio approach is the, let's say, preferred way for capital allocators to engage in this, given that reality of, let's say, power laws on steroids that this industry deploys. So I might just quickly share my screen and
please
put that on paper. So the reason why this space is so interesting is that the decentralized models themselves, they offer unparalleled scale and leverage, right? So we're talking about very small teams which have been able to come together and create things which has typically taken between 10 to 100 years to create. Billion-dollar companies is now happening in the space of less than 18 months, and they're responsible for creating volumes and transacting volumes across what is a sophisticated enough technological architecture and infrastructure to process hundreds of billions of dollars of volume. And sorry for the terminology here that's breaking this down, but this is the different segments of DeFi that we look at. And if we look at the decentralized exchanges, we're talking about an average team size of 11 to 18 people, depending if you look at mean or median, have raised on average 15 to 30 million and have been able to deliver returns to their investors, so token holders who had held it from day one, over the period that we've analyzed. So factually looking at the numbers until this particular one was 30 April 2021, over the years, they've delivered between 11 to 18x on average to their investors. Now, these numbers, again, given that the industry is only within where we've started tracking it since Ethereum itself launched in 2017, let's say, actively tracking this side of the industry and everything that's come next. If we look at what's happened, if we take a look at the numbers by vintage, so tokens that were issued that are still alive today with a market cap above $50 million US, they've actually delivered their investors 12.9x on average. And we see obviously some outliers over the years, but we're so convinced that we're so early on in this process, given what we saw happen in 19 and where that opportunity is today, given that the penetration of DeFi within the crypto economy is only about 5% of wallet holders are actually participating in this space. And the crypto economy anywhere between $1 to $2 trillion is still a fraction of where we believe it will be. So if we explore where that goes, the opportunity that's in front of us is unlike anything that anyone has ever seen in the history of fundamental investing, let's say. And just to put that into context, to throw some not investment advice, of course, but factually tracking numbers on a page, let's say, I mean, Bitcoin and Ethereum since 1 January 2020 have appreciated very incredible amounts from a conventional investment perspective. And this is really now where we're seeing other protocols, other decentralized applications coming through and able to deliver results which are, again, an order of magnitude higher than what anyone thought was even possible, probably even 2 years ago, frankly, and are things that are being realized off the back of participating in these token protocols and projects. So the reason we do it is because there's opportunity there, and we believe in it for the same reasons that the other speakers, that there's an incentive to be a part of it, being early and being a part of this transition, because it is such a big fundamental shift to what's going on.
Okay, it sounds a little bit to me we're in the year 1612 and the share has just been invented. When I hear you talking.
The share has just been invented is the catalyst, but the interesting part is that the share has been invented and everyone in the world is somehow connected, right? So the fact that we have the internet as well is what makes this different from just having developed, ownership and these concepts of fundamental economic principles. So we have all of those. We have technology available for everyone. It's kind of this perfect storm of things, which is creating a momentum which is unparalleled.
And the market is doing its wonders.
Exactly.
Yeah. Diana.
Yeah, Karen, just to add to the words of my colleague Leo, what we are witnessing, and I think it's quite extraordinary, is the creation of a new asset class, actually, from an investment perspective. You don't see this very often, that witnessing a new asset class that could be offered to investors, and even more, probably a nice diversificator, which, the early indications showing. And then the other very, very promising signal that we are witnessing is also the shift from institutional, and the interest from institutional investors. Let's say 2017-18, there was a hype around blockchain, Bitcoin, but there was a lot of retail investors, maybe early adopters, early believers. Now, with the infrastructure has been built, with custody, with the underlying infrastructure which supports the whole sector, the financial sector, that's already appealing to institutional investors. They're increasingly looking into it. And one other very interesting point is because they're driven by the customer demand. So clients are asking, and this we hear more and more, that especially the new generations of high net worth individuals are asking for exposure to this new asset class. And that's why we believe we're in a very exciting times. Of course, it's very early days. Of course, this is an asset class. It's still in its very adoption phase, developing phase. Probably there will be a lot of failures, but out of this, of course, we will witness, within the life cycle of the investment cycle, we will see a lot of also successes there.
Hey, great. Katrin, so now when we have heard about so much opportunities, how do you feel about the risk side of it? Is it really fair to say, returns outweigh risk?
I just wanted to, I think I understood from Leo that the figures the multiples he just presented, that they are the survivors. So
Yes.
let's not forget there's a heavy survivor bias in these figures. On the one hand, also, though it has improved, I do, if I recall the last figures I looked at, all crypto assets, so DeFi protocol tokens still are heavily correlated with the Ether, with the underlying. So I'm not really sure whether we can talk about the mature market there in terms of really assessing comparatively the protocol's long-term value at this point. It's more if they still have a role in the market or a considerable size in the market, it's a lot of, let's say, future value that still has to be generated. And I also doubt that whether these returns necessarily are going to be to that extent also going forward, because if you look at the past year only, or let's say the past 18 months, I think DeFi, depending on what numbers you're looking at, has grown by 50 times their original size. So this is at some point literally not possible anymore.
Yeah,
so
but maybe we have this. Do we have a speculation bubble already in this market? Because well, we know all the behavioral aspects. We know herding network effects. Yeah, probably we have a high survivor bias. Many protocols may have disappeared, but we could argue with good due diligence, you belong you're on the survivor side. So do you think we have already a bubble?
Well, no, not necessarily. I don't know, to be frank. I don't know yet enough about this space and the dynamics, because the new dynamics emerge very fast. I do think that those protocols who are future-proof, prove to be successful in the future, are going to grow further with or actually faster than the ecosystem maybe. But I also do think that the past year and a half, 2 years, we have seen protocols showing up, collecting a couple of millions, even billions of liquidity, and having disappeared within weeks. So I would say I've just heard last week the term crypto years. So 1 year in the normal time is 10 years in crypto. It can go really fast at this point, which is an upside, because innovation is also really fast. But it makes it also very hard to make predictions.
I agree with you, Katrine. Like, if at risk of being a little bit pithy here, there's like my belief is that 99% of crypto assets are undervalued or overvalued. The market has not priced things particularly effectively. And then again, building off of what Matthias introduced, the sort of permissionless nature, that there is no pause button on these markets, means that when things unwind, it is rapid, like immediate.
Exactly. And maybe one thing you just came to my mind, we also need to know that these protocols, DeFi protocols by nature, are open source. So it's very easy for a new player in the market to take a successful business model, a successful protocol model, copy paste it, offer it at slightly more attractive fees.
Yeah, it's definitely interesting. Like, what constitutes an actual moat? There's an interesting term called a vampire attack that most infamously was sort of instituted by these two decentralized exchanges between Uniswap or Unicorn Swap and SushiSwap. For those not terribly familiar with crypto, the names are just an endless amount of fun. But broadly, Uniswap is a very large decentralized exchange where you can trade between assets, and then a sort of competitor sprung up and introduced a token. So there was immediately this tradable asset and incentives for using this protocol. And so a lot of volume moved from Uniswap onto SushiSwap, and that forced Uniswap to introduce its own token. In general, my not financial advice, personal opinion, I think this is actually very good because it introduces a lot of immediate competition into the market. So it is like the jungle out there to survive as a crypto protocol.
Okay.
And those that do survive are like pretty impressive teams.
So currently we have a jungle. We don't have a fully transparent market with which prices the assets correctly. Probably the market is still a little bit too small as well. Yeah, so
I would say it's sorry, Karen, do you mind if I?
Yeah.
I would say it's an irrational market. It's driven by emotions instead of fundamentals. But you can choose to make purchasing decisions based on fundamentals in a way that is impossible in traditional markets, because all of the financial information is like a blockchain is just a public database. So the most up-to-date financial information for a protocol is available, like right there, you know, as if you're the CFO. And so there are some if you're not comfortable interacting with blockchains directly, there are aggregation tools that will tell you information like how much in fee revenue a given market making protocol is generating. And then you can look at that fee revenue relative to the market capitalization for all of its assets that are trading. And you can make purchasing decisions based on the PE ratio. These things are still kind of in the nascent stages, the ability to do this, but it is there in a really exciting way. In general, the market seems to kind of go in its own direction now. It's very driven by emotions.
So the market is still rational, but this happens in other markets as well. So I know we are a little bit over time, but it has been a very, very interesting discussion, and I would like to open the floor for any questions from participants here in the call, be it by chat or just speaking up. Oh, wow, it looks like we are getting an easy run. Any questions from the floor? No more questions. So if there are
Karen,
no questions, yeah.
I think there's still the question by Martin Gundinger on Chainlink.
Who spoke to this?
I think I talked about it. If
yes,
obviously, if you need further clarification or anything else related to this, I'm happy to.
We could talk about MEV or like how prices disaggregate between different base layers. Like Solana shut down or something.
Τίποτα δεν έχω. Παρακολουθούσα κάτι εδώ στο κομπιούτερ. Δεν έχω τίποτα. Όχι. Έχει βραδιάσει και... Ναι.
Yeah.
Από το πονίδια μα θα ξενερώσει ο εγκέφαλος.
Εντάξει, σε ποιο δεν διαβάζω, άκουγα, παρακολουθούσα κάτι. Είχε και ωραίο... Ναι, πες μου.
Okay, I think if you can please...
Άκου, παιδιά, ο μήνας έχει... Τι, δηλαδή... Ένα μήνα έκαμε να έρθει, παιδιά.
Okay, so I believe, thank you very much. This was really a very, very interesting discussion. I think we covered quite a lot of ground. It's a very complex topic. Of course, we couldn't cover all the ground, but I hope that everyone who was in the call now has a much better understanding of the risks and the opportunities in DeFi, and for what kind of investors, what kind of product in this DeFi market would be a solution or part of a solution, and what are the risks and that you need to understand if you want to invest in this market. So, Barbara, do you have any further question? I think you have been so quiet, probably not. So this is the last time to take a question. Otherwise, I will close the session and I will thank you, every one of you, to be part of that. And I see we don't have any further questions. So thank you very much for this very, very inspiring discussion. We hope we can have more sessions like that, because I believe as well it's a very, very important topic. And thanks for your time and effort, to explain that to our audience. Thank you very much.
Thanks, everyone.
Thank you. Bye-bye.
Thank you. Bye-bye.
Thank you. Have a good evening.
Good evening. Bye-bye.